Formats for preparation of financial statements as per Ind AS. Formats were given under Schedule 3, Division 2. Under that Part 1, balance sheet. Balance sheet will have 5 columns. First, serial number. Second, particulars. Third, notes to accounts. That is note number. Fourth, figures as at the end of the current reporting period. Next, fifth column, figures as at the end of the previous reporting period. That means comparatives. First one, asset side. Under assets, first one, non-current assets. Non-current assets includes PP, property, plant, equipment, capital work in progress, investment property, goodwill, other intangible assets under development, biological assets other than bearer plants, financial assets. Financial assets includes investments, trade receivables, loans. Next, deferred tax asset, net. Net means deferred tax asset minus deferred tax liability. The net will be presented here. Next, other non-current assets. Next, current assets. Current assets includes inventory, financial assets. Financial assets again includes investments, trade receivables, cash and cash equivalents, bank balance other than cash and cash equivalents, loans, others to be specified. Next, current tax assets, net, other current assets. This is from total assets side. So we will get the total assets. Total assets, current assets plus non-current assets will give total assets. Next, equity and liabilities. Equity. Equity includes equity share capital, other equity. Next, liabilities. Liabilities are again divided into two categories, non-current liabilities, current liabilities. Non-current liabilities includes financial liabilities. Financial liabilities again includes borrowings, trade payables, total outstanding dues of micro enterprises and small enterprises, MSMEs, and total outstanding dues of creditors other than micro enterprises. Other financial liabilities other than those specified in item number B to be specified here. Next, provisions. Next, deferred tax liabilities, net. Net means deferred tax liabilities minus deferred tax asset. Net needs to be shown here. Other non-current liabilities. This total will give total non-current liabilities. Next, current liabilities. Current liabilities includes financial liabilities. Financial liabilities includes borrowings, trade payables. Trade payables means total outstanding dues from micro enterprises and small enterprises, MSMEs, and total outstanding dues of creditors other than MSMEs. Other financial liabilities other than those specified in item number C. Other current liabilities. Next, provisions. Last, current tax liabilities and net. So total of these two will give equity, total of equity and liabilities. This should match with total assets. Next, statement of changes in equity. Statement of changes in equity contains two items, equity share capital, other equity. Equity share capital, balance at the beginning of the reporting period. That means opening balances should be presented here. Next, changes in equity share capital during the year should be presented here. Last, balance as at the end of the reporting period. That means closing balance should be presented here. So opening balance plus or minus changes gives closing balance in case of equity share capital. In case of other equity following is the format. Other equity includes share application on money pending allotment. Next, equity component of compound financial instruments, reserves and surplus, which includes capital reserve, securities premium, other reserve that is specific in nature. Specify the nature, we need to specify the nature of the reserve and retained earnings. Next, debt instruments. Next, debt instruments through other comprehensive income, equity instruments through other comprehensive income. Next, effective portion of cash flow hedges, revaluation surplus, exchange difference on translating the financial statements. Other items of other comprehensive income, we need to specify the nature, money received against share capital. Total, we need to show in the last column. So these are the other equities. Regarding these other equities, we need to show the balance as at the beginning of the reporting period, changes in accounting policy or prior period errors, restated balance at the beginning of the reporting period, total comprehensive income for the year, dividends, transfer to retained earnings, any other changes to be specified, balance as at the end of the reporting period need to be specified. Regarding other equity, so this is the format regarding other equity. Next part 2, schedule 3 division 2 part 2, statement of P&L, profit or loss. It contains 5 columns: serial number, particulars, note number, figures as at end of the current reporting period, figures for the previous reporting period, that means comparatives. First, revenue from operations, other income. Total of revenue from operations and other income will give total income. Next, expenses. Expenses like cost of materials consumed, purchase of stock in trade, changes in inventory of finished goods, stock in trade and work in progress, employee benefit expense, finance cost, depreciation and amortization expense, other expenses. So total of this will give total expense. Total income less total expense gives profit or loss before exceptional items and tax. Plus or minus exceptional items, we will get profit or loss before tax. Less tax, tax expense. Tax is of two types: current tax, deferred tax. We will get profit or loss for the period from continuing operations. Next, consider profit or loss from discontinuing operations, tax expense of discontinuing operations. Profit or loss from discontinuing operations need to be considered. How to calculate profit or loss from discontinuing operations after tax? Profit or loss from discontinuing operations less tax expense of discontinuing operations. We will get profit or loss from discontinuing operations after tax. Calculate total profit or loss for the period. That is profit or loss for the period from continuing operations after tax plus profit or loss from discontinuing operations after tax. We will get profit or loss for the period. Next, consider other comprehensive income. Other comprehensive income is divided into two categories: items that will not be reclassified to P&L and income tax relating to items that will not be reclassified to P&L. Second, items that will be reclassified to P&L and income tax relating to items that will be reclassified to P&L. Next, when we add profit or loss for the period and other comprehensive income, we will get total comprehensive income for the period comprising of profit or loss and other comprehensive income for the period. Next, calculate earnings per equity share for continuing operations, basic earning per share, diluted earning per share. Next, calculate earnings per equity share for discontinued operations, basic earning per share and diluted earning per share. Next, calculate earning per equity share for both discontinued and continuing operations, basic earning per share and diluted earning per share. Next, other comprehensive income shall be reclassified into items that will not be reclassified to P&L and items that will be reclassified to P&L. What are the items that will not be reclassified to P&L? First, changes in revaluation surplus. Second, remeasurement of the defined benefit plans. Third, equity instruments through other comprehensive income. Fourth, fair value changes relating to own credit risk of financial liabilities designated at fair value through P&L. Share of other comprehensive income in associates and joint ventures to the extent not to be classified into P&L and others. We need to specify the nature regarding others. Next, items that will be reclassified to P&L. Exchange difference in translating the financial statements of a foreign operation. Debt instruments through other comprehensive income. The effective portion of gains and losses on hedging instruments in a cash flow hedge. Share of other comprehensive income in associates and joint ventures to the extent to be classified into P&L and others. In case of others, we need to specify the nature. So these are the items that will be reclassified to P&L. Next, depending upon the turnover of the company, the figures appearing in the financial statements should be rounded off as below. If turnover is less than 100 crores, rounding off to nearest hundreds, thousands, lakhs, millions, or decimals thereof will be done. If the turnover is greater than equals to 100 crores, rounding off will be done to nearest lakhs, millions, or crores, or decimals thereof. Once a unit of measurement is used, it should be used uniformly in the financial statement.